Hello, good morning, investor and corporate. Welcome to Set Digital Roadshow first quarter 20 and 22 performance review. This section will run about 45 minutes, including Q&A. Company will start the section by 30-minute presentation, followed by 15-minute Q&A. And during Q&A, investor may leave your question in meeting room chat box or use raise your hand function. We will open your microphone so you can ask the question to the company directly. So may I now invite Thai Oil Public Company Limited to start the presentation, please. Thank you very much.
Good morning, investors. Welcome to Thai Oil Set Digital Roadshow for our first quarter 2022 performance presentation. My name is Thorsan Chaipravat, Vice President, Financial Planning. Presenting with me today is Kun Pornpiman Srisatayabut, Manager, Petroleum Value Chain Analytics, and Kun Nanchaka Bamrung Suksawat, Assistant Manager, Investor Relations. There will be 3 agendas today, including key highlights, performance analysis, and market outlook. Let me start with the key highlights. In the first quarter of this year, there were 3 factors impacting Thai oil performance. First is the ongoing Russia-Ukraine war, which has caused tightening of growth in both crude and gas oil supply in the market. Second is the China dual control policy to increase its energy efficiency and lower carbon emission, leading to less export, particularly gas oil products. Third is the recovering global oil demand from economic opening as COVID-19 situation eases. Gasoline and gas oil demand have already recovered to the pre-COVID level, while jet demand continues to rise following increasing international flights. We expect jet demand to recover back to the pre-COVID level by next year. As a result, you can see that crude prices has rose Q on Q to the current level around $120 per barrel, while Singapore GRM rose to over $20 per barrel from sharp rise in product crack spreads. On the next page, key performance highlights of Thai oil. Market GRM in the first quarter rose to $6.4 per barrel from $5.4 in the fourth quarter, from higher crack spreads on all products, including gasoline, jet gas oil, and very low sulfur fuel oil, in line with growing economic activities and tight product supply situation. With $25 in crude oil prices Q on Q, Thai oil has a stock gain of $16.2 per barrel and reported accounting GRM at $22.6 per barrel in the first quarter. For aromatics and LAB, we softened benzene margin from high inventory in China as a result of the COVID lockdown, but a robust LAB spreads from strong cleaning products demand. GIM contribution from aromatics and LAB for the first quarter was at $0.7 per barrel, a slight 0.1 decline from Q on Q. For base oil, the spread in the first quarter softened, but still at a healthy level compared to historical average, due to high supply from increasing refinery run and also higher feedstock costs. GIM contribution from base oil in the first quarter was at $0.6 per barrel to $0.2 per barrel lower Q on Q. On the next page, Thai Oil continues our operational excellence actions to capitalize on the improving market condition. For our operation in the first quarter, we processed more Middle East crude as it used more middle distillates to capture higher demand, while continue on our energy optimization to reduce energy costs. We increased our jet production to 12% from 9% in the first quarter, following higher jet demand in the region. We continue to maximize our refinery utilization rate at 109%. Our aromatic run rates was lower at 73% from lower aromatics margin, but we optimized to produce more gasoline. We continue to run LAB at 122% and maintain our base oil utilization at 89%. On the commercial side, we maximize our domestic sale at 86%. Indo-China sale at 13% to capture high demand in the region and also additional gas oil demand from the power plant gas to oil switching. We also expanded our product distribution across the region. On the financial side, we are on track to execute our recapitalization plan. We completed our GPSC share sale earlier in June, and Thai Oil received cash flow of around 19 billion Thai baht net of tax, and used this proceed to repay bridging loan, which we took on last year to invest in Chandra RC. As for the equity offering, we expect to complete the transaction in the third quarter. So in summary, Thai Oil reported a net profit of 7.1 billion Thai baht in the first quarter, while the net operating profit excluding stock gain and hedging loss was reported as 4.1 billion Thai baht. In terms of the net profit contribution, 82% of our net profit in the first quarter came from refinery and lube business, 8% from power, and 10% from other businesses. On the strategy side, we continue our effort to develop our 3V strategy. The first one, value maximization. Our CFP project progress at the end of the first quarter was at 82%. This year, we will complete the construction on site to be ready for commissioning and testing next year. In terms of our investment in Chandra RC, 3 of our management has joined CAP management team to help support on the operation and CAP 2 expansion project development. So far, CAP 2 project is expected to FID, making the final investment decision by the end of this year and commercialization by 2026. As for our aspiration in the high value products, we have set up new department to focus on the development of HVP products. For our second strategy, value enhancement, we are restructuring Top Solvent to become Top Next and changing the business model to integrate and expand our sales and marketing to capture more market shares in our 5 target countries, including Vietnam, Indonesia, Singapore, India, and Myanmar. As for our value diversification strategy, we continue to study and develop new business in 4 focus areas, including bio, new energy and mobility, health, and digital. For the new energy part, in the first quarter, we have invested in a new startup company called Versogen, and they are developing a new green hydrogen technology. And last but not least, on our path toward net zero, Thai Oil has set a target to achieve a net zero carbon emission by the year 2060. And we plan to achieve this target through 4 strategies, including first one, energy efficiency improvement. We have been doing this continuously, and it has been showing a very effective result. Second strategy is decarbonization. We are currently studying on green hydrogen and carbon capture storage technology. Third strategy is a natural-based solution like forestation, and the fourth one is carbon credit. We hope to be able to communicate a clear roadmap to achieve the net zero target by the end of this year. So that's an overview of our first quarter key highlights. Next will be the performance analysis by Khun Antapat.
Thank you. So for the quick recap in terms of the Q1 performance highlight, I will quickly recap it. Firstly, from the utilization rate, as Thorsan has already mentioned, that we always run high, 109% in Q1, mainly because of the better domestic oil demand. As you can see from the upper right graph, shows that year on year it improved around 9.7% for the total oil demand, led by the diesel and jet fuel. However, more gas still drag year on year, mainly more gas drag around 6% year on year, mainly pressured by the COVID Omicron during Q1 this year. However, in terms of the sale breakdown, we still sales mostly to PTOR and others, as you can see in the pie chart. And if you see in terms of domestic and export sale in the below right graph shows that in Q1, Thai Oil maximized the domestic sale at 86% and leave around 14% export. By the export, mainly majority goes to the CLMV countries, around 13%. Only 1% we sell to the other countries such as the Singapore. And in terms of the refinery margin, in Q1, we report $6.4 per barrel of the market GRM. We have seen the improvement in the GRM since Q4 last year onwards. And in Q1, that mainly because of the better oil demand from the reopening country. As you can see, the product spread in the upper table, all the product spread increased in Q1. And it is even better in Q2 today. As you can see, most of the jet and diesel is up to more than right now it's more than $40 per barrel right now. So I would say that in Q2 we're gonna have the strong market GRM. Sorry. So for the Dubai crude oil price, in Q1 this year, it rose quite a lot, more than $40 per barrel, from 73 to $111 per barrel. So that's why we record the stock gain high, around $60 per barrel, and accounting GRM is around $22.6 per barrel. So moving on to the aromatics BU, as you can see, we reported the GIM contribution from aromatic BU at $0.7 per barrel, slightly lower Q1Q, mainly pressured by the pressuring the aromatic product spread, especially in the PX margin. PX and benzene margin. For example, benzene margin was pressured by the high inventory in China, and both of PX and benzene product spread also pressured by the high feedstock cost tracking with your G95. And in terms of the lube-based oil, it's around $0.6 per barrel contribution to GIM, mainly pressured by the base oil product spread, lower base oil product spread Q1Q. Despite, if you compare with the average historical, it's still high in terms of the base oil product spread. And for wrap up in terms of the margin of three main BU, refinery, aromatic, and lube-based oil. Upper left graph shows the gross refinery margin purely on the refinery BU. As you can see, improving from Q4 5.4 to $6.4 per barrel. And with the stock gain, it's increased to 22.6. And as you know that we already fully integrated with aromatic and lube base. So we have another contribution around $1.3 per barrel on top from the GRM. So we reported GIM at $7.6 per barrel, and including stock gain, it was around 23.6. And if you compare with the cash cost side on the right-hand side, for the group cash cost, we still maintain low cash cost. As you can see, $1.3 per barrel is the operating cost, and $1 per barrel is interest expense. So you use the 23.6 of the accounting GIM and minus with the $1.3 per barrel operating cost, you will get roughly the EBITDA level, and you multiply by the crude intake in each quarter. For example, a year we refine around 100 to 110 million barrel a year. So for a quarter, so you could divide it by 4 and you multiply by that, you get roughly the EBITDA level table. And in terms of the power BU, the contribution in Q1 total, it's 288 million baht. It's actually lower Q1Q, mainly pressured by the equity income from the GPSC, which was lower from the higher feedstock cost tracking with the natural gas and coal. So that's why we have the lower contribution from power sector in Q1. And for the next BU is the olefins business that we invest in Chandra Asri by the top investment in Indonesia company. So in Q1, we have reported net loss around $2 million USD, or is equivalent to around net loss around 66 million Thai baht. That was mainly pressured by the pressuring olefins product spread, both of PE and PP, that mainly pressured by the high feedstock costs of naphtha price, tracking with the skyrocketing the crude oil price. And for the remaining BU, I would only say for the solvents and ethanol BU. So in Q1, we have the good contribution from those two BU as solvent and ethanol. As you can see, 362 million baht improved Q on Q, mainly because of higher contribution from the solvent BU that was from the higher gross margin following the rising crude oil price. And also for the ethanol BU is improving contribution as well from the higher ethanol selling price and also the transportation fee. So all in all, in terms of the net profit contribution, we reported consolidated net profit around 7.1 billion Thai baht. So as you can see, as I mentioned, EBITDA was around 13 billion, improved Q on Q from 6 billion last quarter to Q1 this year, 13 billion Thai baht, mainly because of improving the GIM contribution. However, in this quarter, we had the realized loss on the financial instrument. So mainly because of commodity hedging that we did as a risk management for Thai oil. So we have lost about 5.7 billion Thai baht. And next, I would touch a bit on in terms of the cash flow position of Thai oil. In Q1, for operating cash flow, we had the significantly improved operating cash flow to around 6 billion Thai baht, mainly because of because of improving net income, mainly from improving the GIM, as I mentioned. However, we have used the money. We have spent the money from the investing activities. So you can see that investing cash outflow is around 7 billion Thai baht. It was mainly because of we spent in the capex of the CFP project. So in terms of the free cash flow, it's improved significantly from negative 8 billion to around negative only 800 million Thai baht. However, we have the cash from the financing activity around 4 billion Thai baht. So in terms of the position of cash increased around 3 billion Thai baht in ending quarter one from 30 billion Thai baht as end of last year to around 33 billion Thai baht in end of the 30th March this year. Lastly, in terms of the financial position, as you can see, we have total asset around 389 billion Thai baht, or is equivalent around 11 to 12 billion USD. So as you can see from the total asset, cash around 1 billion USD, and another portion is for the current asset and non-current asset. Non-current asset improved Q on Q, mainly we spent on the capex spending for the CFP project and also our investment project. And in terms of the debt side, we had the interest-bearing debt around 5.6 billion USD. So if you deduct the 1 billion cash, net debt position is around 4.6 billion USD. And in terms of the currency breakdown for debt portfolio of Thai oil, 63% is USD currency and 40% is Thai baht. And the interest rate was already fixed at almost 70%. For both financial ratio, key financial ratio of net debt per EBITDA and net debt per equity, it's improved. For example, net debt per EBITDA is low to around 4.7 times, mainly because of the improving EBITDA. And for the net debt per equity, it's maintained at around 1.2 times. However, if we complete the recapitalization plan that we have mentioned earlier, so we think that these financial ratios gonna normalize at for example, net debt per equity will be around 1 times. And in terms of the final rating of the credit rating agency, 3 of them also rate as the investment grade credit rating. So I think it's covered financial performance analysis. Next, I would like to hand over to Khun Phornpiman for market outlook.
Okay, thank you, Ka. So let's move to the outlook for the market for the second half of this year. So we divide into four parts. Like let's start with the crude market first. The crude market for the second half of this year, we still expect the market to remain like uncertainty and still expect the market to be concerned on like a tight supply market, especially on the Russian sanction and also on the outage of the other oil producer as well. If you look at the chart A, maybe we can see that in the short term, we didn't see like impact much because of the Russian cargo can flow into like other buyers apart from like EU try not to buy the cargo, but other Asian, right, China and also India, the export volume from Russia is increasing. But we still expect that the outlook for the second half of this year would be tighter because of the we still expect the supply to be from Russia to be disrupted after the EU ban and oil embargo, and also the sanction on the insurance of the crude oil vessel that make the transportation difficulties. And overall, so recently, the estimation of the Russian disruption would be around would be around 2.6, including the crude oil and also the refined product as well. And that's why we still expect the market to be quite strong at this high level. But we still see that there's some potential of the additional supply replacement as well in the charge B. The first one is the SPR release, mainly from the US and also other IEA country. And the second one is the OPEC Plus. OPEC Plus is trying to increase their production, but the market still expect that they might not be produce as much as their target because of the limited spare capacity concerns. The third one is the higher production from non-OPEC supply, mainly from the US, which with this current high crude price, like maybe incentive for them to like increasing the production for the rest of this year. And the fourth supplier would be Iran or maybe the Venezuela, which they are now currently under the sanction, but there might be possibility of the partial release of the Venezuela sanction and also the Iranian sanction in by the end of this year or maybe by the first quarter of next year as well. So in overall, we might see that the supply disruption from Russia might be can be fulfilled by like other supply replacement like we show in the chart A. But like I mentioned earlier, in the chart B, we show the global spare capacity mainly for the OPEC producer. You can see that the spare capacity for currently and the rest of the year is very limited. So that's why we say that there's a still like uncertainty on how OPEC Plus and OPEC member can like increase their production to meet that target or not. Together with the high expectation of the higher global demand for the rest of this year, after like China COVID lockdown improvement, and also we also expect the global economy to be improving like in the second half as well. So if you look at the total demand and supply balance, we would see that the second half of this year in Q2, 3, and 4 would be see some increasing both of the demand and also both of the supply. And if you see the stock, maybe there will be the slightly stock build, but only in Q2 and Q3. But with this like quite small like stock build at this level, so maybe market still concerned because if there is any like outage or there any other disruption come into the other supplier in the market, so the market will be very tight. So that's why overall like picture we still think that the market will be quite strong, but maybe tend to be softer due to the additional supply from supplier as well for the rest of this year. So then we move to another market highlight. As you can see that in overall like picture, the petroleum product or the refined product margin or the crack is also very strong at this moment. And we also expect the situation for the rest of this year, but maybe it's not too strong as the current level. The four factor that we are consider is the first one in the chart A. We also expect the demand for the global product like gas oil in the orange color and gasoline in the green colors to be back to pre-COVID already and keep increasing for the rest of this year. But only the jet, which in the blue line, is keep increasing as well. Even there will not be reached the pre-COVID level, but the trend is increasing or improving. And like Khun Thorsan mentioned earlier, we expect the global jet demand will be reach the pre-COVID level maybe next year. The second thing is on the supply side. On the chart B, you can see that during the past 2 years, during COVID 2020 and also last year 2021, there's a lot of the global refinery have to be closed due to very low margin and also is not competitive in the market. So that's why overall refinery capacity is reduced a lot during the past 2 years. And also, if we look at the global refinery run on the lower graph in the chart B, we can see that since last year and earlier of this year, overall refinery run rate is lack of the pre-COVID level, which show in the orange line. We reference 2019 for the reference. But in the rest of this year, maybe there's tend to increase slightly with the higher margin at the moment and also with the additional capacity of the new refinery as well. And move to the chart C, you can see that we still expect the supply to be very tight from less export from China as well. Since last year that China tried to minimize their export quota, and also they also reduced the quota a lot. Just only for this year, they're only the first batch of the export quota, and just recently, just early of this month, they just announced the second batch of quota, but the volume is about 50% lower than last year. So that show that China they are trying to keep supply the domestic and try not to export a lot. And also the lower graph of lower chart of the graph C is the export volume of the main products, which are gas oil and gasoline and also jet and kerosene. You can see that typically since last year, early of last year, before they implemented tax implementation, the total export product would be size about 1,000 kbd. But now, since the second half of last year, after they tried to implement the import tax, the volume of the export is dropped a lot to about 500 kbd. So that's why they keep cumulative the lower supply from China. So that's why in overall picture of the supply in the market now is quite tight for the refined products. And together with the chart C, there's a concerns on the Russian disruption, not only on the crude like we mentioned earlier, but it's also on the refined product as well. Overall, for this year, we expect the Russian export on the product, both of the gas oil, fuel oil, and also gasoline, and some of the naphtha is decreasing for this year comparing to the early of this year before the invasion happened. And with this a factor A, B, C, and D, so it's turned now the inventory of the key products, three key products in the 5 main areas in globally is looks very low, and I think it's lowest than 5-year average and the lowest level at the moment. So that's why we see that the product price is very strong at this point of time. And if we look at the refinery margin on the Singapore cracking GRM, we will see that Q2 is about about $20 per barrel already. And for the rest of this year, we still think that the overall GRM look remain good and quite strong, but there might some possibility of the slightly softer on the GRM as well. The supportive factor that we still think that the margin would be very strong is because of the strong demand from the gasoline, so jet demand and also the gas oil demand. But and also the lower stock globally. But the pressure things is about the higher supply from new refinery capacity as well. So if we look at the additional capacity for this year, we will see that there would be some other new refinery from China as well, but we didn't take into account the additional China supply much because of we still think the China government try to minimize the quota. But we look at the additional supply from Middle East, which are the Saudi Arabia, the recent one. They already start up since last year, but they run about 50% from time to time. But now there's a news that during Q2, during June, July, and August, they try to ramp up their run to meet about 100%. So that's why we still expect the additional supply product from the Middle East. And also another big capacity addition from Kuwait, the outsource one, which is about 600 kbd. Actually this refinery is expected to start up in Q4 20, but now there might be possible to delay to Q1 or Q2 2013. But recently we just heard from the market that they also try to start up or try to trial run by the second half of this year as well, maybe to capture the high margin for this year. And if you consider the AP, ME, Asia Pacific and Middle East capacity addition together with the supply addition, so we still expect the demand to be growth at higher rate if you look at the overall picture for this year. And for the next year and the next few year, for the next year there may be another additional capacity, but after 2024 onwards, we didn't expect to see much on the mega project. So overall, in the medium term, the refinery margin will be quite strong. So let's move to the another industry. So move to the aromatics market. So the aromatic market, now we might see some improving demand of the aromatic market thanks to the improving the COVID situation in China. After they try to announce the lockdown and there's some announcement of there's some expectation of the improving the economic as well. So we expect the demand for the second half would be growth about 1.5, which is higher than the first half of this year. And for the PX product for the PX market. And similar things on the benzene one. We also expect the demand for the second half will be growth around about 1 M ton as well. So that's why we still think that the aromatics market there's a room to improve as well. And similar picture to the aromatic market, the olefins market. Even we see the higher additional capacity to come online in the rest of this year, but we also expect the demand growth of the second half of this year to be higher as well. So the HDPE and also the PP demand supply would be quite balancing. And then move to the base oil and bitumen market. Base oil market, the first half of this year is a bit softer comparing to last year because we see some increasing in the refinery run rates, which is resulting to the higher the base oil supply as well. But for the second half of this year, we seen some announcement the plant to be closed in Singapore and also in Japan, which is the Shell refinery, Shell base oil plant, and also the ENEOS base oil plant as well to be closed. So that's why we still think that the overall base oil market in terms of the supply to be higher, and there's a softer in terms of the margin, but the level will be quite strong. And on the bitumen market on the chart D, there's we also expect to see the room of improvement as well because of the bitumen market is now try to tracking the higher oil price. So we expect to see the spread between the bitumen and also fuel oil as a feedstock to be slightly increasing. but to limit upside with the raining season during like Q3 this year. So in conclusion, for the 5 aspect of the 5 market, the crude oil price, we expect to see more supply from SPR release and OPEC and non-OPEC supply, but limited with the spare capacity. So we expect to see a slightly softer trend, but the level should be higher than $100 per barrel. In terms of the refinery sectors, we're promising the refinery margin to be strong as a demand quite strong, and also the low inventory globally as well. And the aromatic side, improving demand to be support the growth, to be support the aromatics market, and also on the olefin side to be the similar picture as the aromatics one. And the base oil market, maybe the market a little bit softer, but the plant-based oil closure to be the limit the downside risk. And this is all of the information on the outlook side.
Okay, if no other questions, I would like to thank all the investors and analysts for joining this session. And we hope to see you again next quarter. Thank you very much.
So on behalf of the Stock Exchange of Thailand, I would like to thank you, investor and corporate, for joining the conference. We look forward to welcome you all again in the next quarter. Thank you very much and have a good day. ขอบคุณนะคะ
Thank you.
Thank you. Goodbye.